May, June 2015, we're looking at RSK3701 in a risk management paper. Obviously, this is focusing on short-term insurance, so we're going to be answering the questions that we've looked at from the textbook as well as the study guide, and you'll see some of these questions are even repetitive. They test very similar sections as they do in most of the exams. Okay, so for question 1, my answer was option 3. Okay, claims assessors are also known as loss adjusters. Okay, a loss adjuster is basically establishing what the loss is. Okay?
Yes.
Alright. Question 2, indemnity in terms of insurance is enforced through the principles of. This was 3, contribution. Okay, I went with contribution there, option 3. That was from page 32. Oh, sorry.
They give you a list.
Yeah, they give you a list. It's contribution and subrogation. Both of them are part of indemnity. Okay, because remember, what is indemnity? Indemnity is putting the person back into the position they were before. Okay, so question 2's answer was 3. A and C are both correct. Question 3, a robbery at a bank in Joburg. Okay, Absa Bank in Joburg is an example of, again, this would be particular risk. It's affecting a particular company. Industry even. Okay, question 4 was looking at, this was a car was worth 400,000 with 250 with X and 250 with Y. Okay, A is involved in an accident and damage to the car is 25,000. His claim, however, is repudiated due to some technical reasons. Company Y, however, decides to make an ex gratia payment. Okay, just to revise, ex gratia payments are payments that are made like goodwill payments. It's basically the insurer saying, well, you're a good client, it's a minor expense that we need to pay for, and because you are one of our clients, your policy doesn't specifically cover the loss, but we'll still pay out the claim anyway. That's ex gratia. Okay, so ex gratia payments, the answer here would be question 4, option 1. They are compensation payments. Ex gratia payments do not affect your claims history. Okay, so your claims history isn't going to be affected if a company chooses to pay out a claim that wasn't covered under your policy. Making sense?
Yes.
Okay. Right, question 5. Indicate the correct statement. One statement is correct, others are false. Long-term policies are policies of compensation. Okay, number 1 was talking about caveat emptor. Okay, remember caveat emptor is let the buyer beware, and uberame fides was the other one that was in good faith. Remember that?
Well, yes.
Uberame. Ooh, spelling. Okay, good faith. Let's write good faith rather. Okay, where's that Latin terms again? Okay, there, good faith. There, caveat emptor. There's it. There's caveat emptor. Okay, let the buyer beware. Okay, I don't find the uberame fides. Where is it? Oh, yeah, there's it.
There's it there at the bottom.
Yeah, here's it at the bottom. Yeah, insurance contracts are among the few that are not contracts of caveat emptor, but uberame fide. Okay, or fides, depending on, I think in the textbook they said fides or fide, okay, either or, but it's the Latin term, in good faith or let the buyer beware. Alright, so this one was 3. Okay, question 6 answer, I went with A, or 1, defined as the payment of a premium. That's consideration.
Okay.
Consideration is when we actually pay the premium. It's not one of the others. Okay, question 7. This was, this is actually what we just did.
Yeah.
Okay, we did that in the long question in October, November 2015. In May, June 2016, it was a short question, and there's the answer, number 3. Okay, number 8, a change in consumer preferences for specific products offered by a financial institution represents a what risk? Again, I went with particular risk here because it's specific to the financial institution and its products that they're offering. It's not the market in general, it's just one particular area in the market. Okay, question 9. In terms of the Short-Term Insurance Act, intermediaries. Number 4, A, B, and C are all correct. Must have written authorization to handle premiums. They must pay premiums over within 15 days. They must provide a statement of premiums and commissions due. And they may they may deduct commissions and any refunds and pay the nets. Okay, so all of those are correct. Okay, so question 9's answer was 4. Question 10's answer is looking at all risk policies. Okay, all risk policies, and that it's asset all risk, so we're looking at those items. Okay, for question 10, I went with 3 policies of exclusions. Okay, remember we spoke about exceptions and exclusions?
Yes.
Exclusions can be deleted, meaning you could actually include something that was excluded. Possible. Okay. That was number 3. Alright, question 11 is that hull insurance again covers collusion liability. That's number 4. Same as what we saw previously, hey?
Yes.
Question 12, indicate the correct statement. I went with 3 here. Personal accident policies are short-term policies.
Yes, correct.
Question 13, in terms of an insurance policies, I went with 1 here. The cancellation clause is under the general conditions. Yeah, that's common sense. Number 14, indicate the correct statement. Here we were looking at those exemptions, exclusions. You're looking at collusion and theft. Okay, so question 14, I went with question 14, 4. Loss of damage arising from war is a general exclusion to all short-term policies. Okay, yeah, war isn't covered. Collusion or theft by employees is a general exception to most accident policies. No, yeah, the others are incorrect. The one that is correct would be number 4.
Okay.
Okay, do you agree? Have you also done the?
Yes.
Did you also do the past paper ahead of time?
I just answered a few questions.
Okay, a few of them, not all.
Not all.
Okay, so maybe let's just check the others here then. Yeah, definitely not. Cover
But they seem to be repetitions from past year papers, so I wasn't too worried about them.
Oh yeah, sometimes there are some overlap and repetition, but don't always count on that because, as you said, the INV was different to previous papers. Okay, but
yes.
INV
so I mean, in terms of
but INV is a very good module. I mean,
Lisa
does a very good job with managing that module. So I've never ever seen papers that are the same in that particular module. They're always different. Yeah, but in risk, we never know. There could be some copy-paste questions.
Yeah.
Okay. Right, exceptions to policies can be deleted? No. It's exclusions. Right, so yeah, number 4 is correct. Okay, 15, I went with. This was... this was the reason why we would use reinsurance. Okay, so obviously smaller businesses need to grow, so they would implement number 2, a quota share treaty, if they're wanting to write new business and they're too small and they're still growing. Okay, question 16, indicate the correct statement. Okay, if I'm looking at the correct statement, we're focusing on limits of liability and then looking at sum insured. Okay, so obviously we're looking at the sum insured here. What is the sum insured? Well, it's the amount that they're indicating as the amount of financial loss. It'll be covered by insurance where the amount of loss that could occur is not known at the time the policy is issued. Okay, so that's something like they're going to pay losses up to 100,000 or 200,000 or 300,000, depending on what the sum assured is. Okay, the sum assured is basically the amount of loss that you could sustain that will be covered under a particular policy. Okay, question 17 is looking at homeowner's policy. Okay, a little bit different, right? Because we're not looking at the householders, which is the contents. This is the infrastructure. Okay, so a homeowner's policy covers the buildings and outbuildings of residents, but can also be extended to include. Okay, wear and tear, never. Okay, you're never going to be able to include wear and tear. Fixed sanitary against chipping and scratching, that could also be considered wear and tear. Number 3, accidental damage to television set and video cassette recorders. Okay, that's the contents. Okay, and then number 4, fixed television antenna against breakage. Okay, so I actually went to the textbook to check this one. This was question 17. 133. Why did I put 133 here? Oh, okay, yeah. If you look at the extensions, it's under house owners policy. It's just after the definition and the perils covered. Okay, there's a section here, 8.2.5, that says extensions to cover, and then they list all of them. Do you have the same thing in your textbook?
It's page 159 in the textbook.
Okay, great. But you're seeing the same list as me, right?
Yes, there is a list.
To cover loss of rent, liability to the public, and all of that, right?
Yes.
Okay, so if you look at this, you'll see they talk about loss of rent, which isn't here. They talk about liability to the public, which isn't here. Then they talk about accidental damage to mains such as water, electricity, gas, and telephone connections at the dwelling. Okay, also not here. Then they say accidental breakage of fixed sanitary ware and glass. This covers, for example, broken windows and cracked hand basins. Okay, so do you agree chipping and scratching to me seems more like wear and tear than accidental damage?
Yes.
Okay, but if this was considered accidental damage, then I would go with 2. Costs of following a loss of architecture's fees, demolition, and so on, that's not part of this. Okay, the only reason why I'm going with 2 and not 3 or 4 is because 3 and 4 is looking at the contents. But 4, fixed television antenna against breakage. But that will be part of the infrastructure.
Yeah.
Okay, so that wouldn't be extended because the television antenna, remember, is part of the building. It's secured to the building. Anything secured to the building is part of the building.
Okay.
Okay, you could specifically include it, but I mean, if it's part of the building and it's fixed to the building, then it should be considered part of its infrastructure. So, okay, so put it this way. Number 2 could be correct if it's accidental damage. So I'm just going to put a note here in the Excel spreadsheet, which I'll send to you later on. Accidental damage would be covered. For sanitary ware. Just be careful with that. So it's a bit tricky. I'm not too sure what they're wanting to focus on here because number 2 sounds pretty good if we're assuming the chipping and scratching is due to accidental damage. Number 4 is talking about the fixed antenna, which is part of the building, so it should be automatically included as part of the house owner's policy because that's infrastructure. Okay, so it's a bit difficult to consider what is the actual how can I say, focus here. It could be 2 or 4. I like 2 slightly better than 4 because it actually mentions it in the extensions to cover in the textbook. But the key word in the textbook is accidental damage. That's the only thing.
Yeah.
Okay, so as long as we assume that the fixed sanitary wear against tripping and scratching is due to accidental damage, then that would be the correct answer. Number 4 could also be correct if they're assuming that the policy doesn't include the antenna, and then you're going to have to specifically include it as a separate fitting. Does that make sense?
Yes, it does.
Yeah, because
it doesn't specifically state in the extension.
Pardon?
It doesn't specifically state under extension.
Yeah, it doesn't specifically state under extension. But if you look at the householder's definition, see, they say this policy is designed to cover the contents of a private dwelling. In other words, all movable property.
Yeah.
Yeah, so movable property, and then see, they even say the definition here. Contents is defined in the policy wording as household goods and personal effects of every description, the property of the insured for which he is responsible, or of any member of his family normally living with him. Any fixtures and fittings belonging to the insured or for which he is responsible, but not landlord's fittings and fixtures, all in the building described in the schedule. So see, it's like permanent stuff. So for example, like if you, let's say, if you were living in a complex and you, let's say you bought a DSTV dish and you put it up into your unit, does that become part of the complex, or does that still become your property?
You installed it, so it should be part of your
contents. It's not.
Yeah.
It actually becomes part of the unit. So if you put a DSTV dish in a unit, it becomes part of the unit, not part of the owner, because now it's a fitting. It's actually part of the structure. So any improvements. I mean, if you put up a gate, a security gate, or if you put up an antenna, it actually becomes part of the infrastructure of the property. So you're actually not allowed to take it down when you leave the unit, because it's actually part of the unit now.
Okay.
Yeah, so that's why I'm talking about this as being infrastructure. So I like 2 slightly better, but only assuming that it was for accidental damage.
Okay.
Okay. 18. 18, I went with 3 here. B and C is correct. Any underwriting changes come into effect immediately, and premiums are paid monthly for a monthly policy.
Okay.
Number 19 is what we've seen before. They like this, seems like it. They tested it a lot 2 years back, 2015. Net profit plus standing charges. 20, a company with an excess claim reserve. Okay, so if they have an excess claim reserve, here we're going to have a higher solvency margin. Okay, it wouldn't be a lower loss ratio, it'll be a higher loss ratio. It's a bit different to that other question we saw previously.
Yeah.
Okay, it's an excessive claim reserve, so there'll be a higher solvency margin. Okay, because we've provided for more capital in order to pay out claims.
Okay.
Okay, 21 is looking at the business interruption insurance again. Okay, they look at the standing charges. Right, so standing charges includes costs such as car leases and rents. Things that don't change. It's almost like fixed costs, if you will. Okay, from a finance point of view. Okay, in risk, they talk about standing charges for business interruption insurance. Got that?
Yes.
Okay. 22, this was the value of the crop. This was looking at the special condition again. Okay, so now we need to do a bit of a working here. So in order to do the working, did I put the working? let's just check. 22. Did I? Yeah. Okay, so what I did is I took this. I took value of the crop times it by 75%. Okay, what is the value of the crop times 75%? 125 times 75%. 125 times 75% gave me 93,75. Okay, 93,75. 93,750. Okay, that's 75% of the value of the crop. The farmer insures his crop for 80,000. Is that lower than the 93?
Yes.
Yes, it is. It is lower. So is he going to have to share in the loss?
Yes.
Yes, he would. Okay, the loss was 50. Is sustained the amount that's payable by the insurer. Right, so the insurer is only going to pay a portion of the loss. How much is the insurer going to pay? 50,000 times 80 over the 125, which is 32,000. That's how much the insurer pays. Okay, because they are going to share in the loss because he's basically underinsured. Are you okay with that one?
Yes.
32,000. Okay, it's a little bit different because we had to work out the one amount.
Mm-hmm.
Great. Next one. 23. 23's answer, I went with 2 here. In terms of common law, issuing a policy document is not essential for the conclusion of an insurance contract. Number 24, the following items will most likely be covered by all risk insurance policy. Okay, if it's all risk, what does that mean? It could be anywhere.
Everything.
It doesn't only have to be at the house, right?
Yes.
Okay, so engagement ring lost on the beach would be covered. Cricket bat stolen from the locker room will be covered because it's not being in use. Camera stolen from a locked motor vehicle in a shopping mall. If it's a locked motor vehicle, so it will be covered. A computer stolen during a burglary at home, that's content, so it could be at home or away, so that would also be covered. Okay, so 24, all of those would be covered.
Okay.
25, once the underwriting department has notified that a claim will be settled, it could. Increase the no claims bonus, no, they wouldn't do that. Delete the lost item, they could. Reinstate the sum insured, they could. Conduct a post-loss survey, they could. B, C, D. Option 2. Okay, 26 is looking at which is the correct statement. Theft of money or employees is not covered under money insurance. The breakage of front windows is covered under glass insurance, definitely. Question 26, option 2. Okay, money transported to and from the bank under fidelity guarantee. Remember, fidelity guarantee insurance, remember, think about infidelity. Okay, people not having morals and ethics, so that would be employees stealing. Okay, fidelity guarantee insurance refers to employees stealing from the business. Not money transported to and from the bank. That's something separate. Okay, shoplifting is covered under theft insurance. Shoplifting, that was theft insurance. I forget now why didn't I choose that one. Let me quickly check. Theft insurance. Where's our commercial insurance? There's our commercial. Okay, where's theft? Okay, there's money. Theft. I think theft was an exclusion, if I'm not mistaken. Let's just check that. Where's theft? Where's theft? Ah, there's theft. Theft insurance. Theft by shoplifting is not covered. Yeah, it was. It was excluded. Okay, so it's specific. It's actually in the textbook. They describe theft as being a robbery. Okay, so meaning someone actually breaks into the store and steals all your goods. That's theft insurance. Shoplifting isn't covered under theft insurance.
Okay.
Okay, it's actually excluded. Right, then we've got 27, which is looking at that arbitration, negotiation, and litigation. Okay, those are different things that we can use to remedy disputes. Okay, number 4 is correct. Arbitration is only used to resolve problems of quantum. Okay, where there's a debate about the amounts. Right, then you've got motor trade policies. Okay, so this is opposite to what we saw in October, November 2015. Here they're looking at external policies. So external policies only cover vehicles damaged at the premise? No, because that's internal. Covers the insured vehicles and vehicles in vehicle custody? Yes. Can be rated on a trade plate basis? That would be correct. Covers vehicles temporary garage? Correct. Okay, so BCD, option 2. Okay, it's the opposite of what we spoke about earlier, where we looked at internal policies. 29. An insurer enters into a quota share agreement. Quota share meaning they're splitting. The ceding insurer retaining, with the ceding insurer retaining 60% of any loss. Okay, so the insurer keeps 60%. They want to know, what does the reinsurer pay? So they pay 40% of 60,000, which is 24,000. Easy one. Okay, number 30, I'm going to have to do a working for 30. We need that recapture thing again. Recapture. There's the formula. Take the formula, put that in our working. Alright, go back to the question and let's read it. Okay, so consider a policy with a 10. They want to know, determine the amount of the deductible the insured would pay for a loss of 45. Okay, so the payment by the insurer is going to equal the loss, which was how much here? 45,000. Minus the deductible here, which was 10,000. Close brackets times open brackets 1 plus the recapture factor of 0.5 equals. Okay, so if I take all of that and I plug that into the calculator, I get 36,750. 36,750 is the amount that the insurer pays. They said here, determine the amount of the deductible the insurance would pay for a loss. So it'll be 45 less 36750. Okay, so insured equals 45,000 minus the amount that they pay, which is 8,250. Is that okay?
Yes.
Right, so you just plug it into the formula, maybe just to show that quickly. Okay, there's the working that I was discussing. Okay, the formula, plug in that value there, you get 36,750, which is the amount that the insurer is going to pay. Okay, so option 4 for question 30. Right, and there were no true and false questions here, so I can delete that. No true and false here. There's long questions, so question 1 is focusing on required says captive. You are required to make a recommendation on the most appropriate form of captive in this particular circumstance. Okay, so remember, you get renter captives and you get captives. Captive is a formal way for creating a self-funding entity that's going to help your business pay for losses. Okay, they want you to support your answer by referring to the distinguishing characteristics and benefits associated with each of the two captives. Right, so this is theory. Remember, captives is part of self-insurance, which UNISA has created a separate chapter for. There's captives. Okay, what is a captive? How do captives work? Reasons for establishing a captive. There's it there. Okay, so what did they want here? They said distinguishing characteristics and benefits associated with each of the two. Right, so if you read the scenario, they say the organization for which you are currently working as a risk management consultant will be engaging in a new venture for the next 2 years. The risks associated with the venture are not considered to be insurable by the private insurance market. Management is considering two options, namely establishing own captive or joining a rent captive. So they've even given it to you in the question. Right, so we need to define them. Okay, so captive. What is a captive? There's the definition. So we need to define a captive. Then they want the definition for rent a captive. Let's define that. Where's rent a captive? There's rent a captive. There's the description. Okay. And then they also said what in the question? They said distinguishing characteristics and benefits with each of the different captives. Okay, so here are advantages for rent-a-captive. So while I'm here, I'm just going to take this through to our working. Okay, that's for rent-a-captive. Rent-a-captives have those advantages, and then for captives you're going to have to go back up to where we had this feasibility studies. Where is it? Here is it. All of these. There's a lot. Reasons for establishing captives. I would be using all of this in the discussion here for captives. Captives. And yeah, you would put literally all of this, so there's a lot here. Okay, I'm just going to write there etc, etc. Page, what page number was this? 114. 114. Study guide. Is that okay?
Yes.
Question number 2. Explain what a deductible is and argue the value of it in the insurance industry. Use numerical examples to distinguish between the following types of deductible. Okay, so again, straight from the textbook, you've got straight, aggregate, and franchise. We first need to describe what a deductible is, so make sure you define it. Deductible, this is looking at self-insurance. It's basically like an excess. An excess is a form of deductible because you pay the excess first and then the insurer pays the rest. Do you agree?
Yes.
Okay, so deductible. There. What are deductibles? Okay, then you've got the different levels. Okay, I think let's go back to this page. There might be a nice definition for it here. Okay, yeah, what are deductibles? Page 106. Okay, so let's use that page. Okay, so that would be part of the deductibles, self-funding to reduce insurance costs. The insured share of the loss is known as the deductible excess. So it's even there. That's even the nice, simple, easy definition. We don't need to say more than that. And then we need to show what the different deductibles are. So then you had straight, aggregate, and all of those. Franchise. Let's see where that is. Straight, aggregate, franchise. There we go. Straight deductibles, aggregate, and franchise. So they're all here. Types of deductibles. There we go. Okay, types of deductibles. There's the straight deductible. Put that in. There's the aggregate deductible. That's part of the answer. And the last one they wanted here was they didn't want the disappearing deductible, so we can leave that one. and they wanted the franchise deductible. Okay, and that was question 2. Happy?
Yes.
Okay, so question 2 was just straight aggregate and franchise. It's 6 marks for each of those, so 2 marks for each, I guess. They did ask you to explain what the deductible is and argue the value of it is in the insurance. Okay, I forgot to write a note about that. Let's go back to deductible. Just to argue the reason why we would use it. We saw that earlier. Where is it now? There. Why should a company consider deductibles as a okay, it's even in the question here. This is even quite nice. Number 2, a large deductible may, see, there's it there. So I'm going to use this. That could be a reason that you could use in this question to motivate why you would use a deductible. Is that okay? Okay, so we're just looking at the reasons why you would have a deductible, which would be part of it's self-funding basically. There, reasons, I see some more reasons. Oh, these are captives. Anything else here that talks about to improve cash flow? Yeah, you can maybe use these definitions as well. To improve cash flow, I'm just going to add an extra note here next to this on the Excel. Okay, to improve cash flow, to provide opportunity to invest, and to increase risks covered. Okay, yeah, those are the basic principles. You could maybe expand on these paragraphs if you wanted to. You could use more of that in your description for the actual first bit. They said argue the value of it in the insurance industry. Okay, so why is the deductible valuable? Is that alright?
Yes.
Okay, then we've got question 3. Question 3 says, define insurable interest as applied to short-term insurance industry. Indicate how insurable interest requirements differ when applied to general, marine, and insurance losses. Okay, this is straight from the textbook. I think the study guide might also have it. Let's just check. Insurable interest. There's insurable interest. Let's copy that. Okay, so let's first define insurable interest. There's the definition for insurable interest. Then we need all those different scenarios where we have the marine insurance general. Insurable interest.
Yeah,
there we go. It's all over here. There's the table. I'm going to take all of that. This was what page is this in the page 34? Page 34, study guide. Okay, happy with number 3? Number 4, discuss the cover provided under theft insurance under the following headings. The importance of forcible and violent entry or exit, first time insurance. Okay, that's also easy. That comes from the textbook. Theft insurance, question 4. Okay, I've got the page still open here from the other discussion. Page 152 textbook. Or, what page is it in your textbook?
Page 180.
180. Okay, and there they talk about violently gaining entry into the property. The importance of forcible, that's on page 153. They talk about extensions and underwriting considerations. And then just below that, they talk about the first loss sum insured. Okay, so it's all in the textbook here. I'm going to write page 153 as well. This was the first loss insured that they covered there as well. Okay, it's only for 5 marks, so you don't have to write too much as long as you cover. Remember, if you leave your, let's say if you leave your house unlocked and open to the public and things get stolen, or your business, will they cover that?
No.
No, they won't. Okay, there needs to be forcible entry. So they have to actually break in order for the claim to be successful. Okay, question 5. 5 is looking at determine whether facultative cover is needed or calculations are shown. Okay, that's easy. Okay, so I think let me move my page across and I can show you the working. Ooh, too big. Okay, question number 5. Right, this is looking at quota share treaties, or line 995 line. What line do we have here? Okay, so sum insured 50 million for fire, 30 million for loss of profits. Has a net line of 2 million and can take additional 50%. It's a 9-line surplus treaty. Okay, so 2 million plus 2 million times 9. 9 times 2 is 18, that gives you 20 million. Plus 10% of 20 million is, 10% of 20 million is how much? 2 million. So 22 million total. Do you agree with that? Is that okay, Melanie?
Yes, it is.
Okay, yeah, so it's 2 million plus the 2 times 9 lines, which gives you the 20 plus 10% of 20 million. 50%. Why did I use 10%? 50% of 20 million. 50% of 20 million is 10 million. This is 30 million. Mistake. Okay, 30 million. Right, so determine whether facultative cover will be needed. Facultative will be needed. For the extra 50 million. Okay, the total they have available is only 30 million. Right. Happy with that one?
Yes.
Okay. Next question. Question 6. Question 6 says, explain the cover provided under minor and major. Okay, this is a repeat question. We just spoke about it in the other exam. So money insurance. Page. What page is it in your book?
184.
184, okay. And in this book, 156. Okay, so 156. 184. Okay, and then they talk about that 5,000 again. 5,000 limits. Okay, and that's question 6. And that's it. Okay, so MayJune2015, not so bad. There was more multiple choice here, which is quite nice.
Yeah.
Okay, so yeah, so that's another past paper we've completed. Any questions?
No questions.